Inflation just hit 3.8%, highest in 3 years, and it's climbing again, not from stimulus this time, from tariffs. Every box that crosses a border now costs you more. Your savings account pays you 0.38% on average. Inflation eats 3.8. You're losing 3.42% of your money every year for the privilege of keeping it safe. Meanwhile, the wealthiest households in America added trillions to their net worth during the last inflation cycle. Not despite it, because of it. Today, we're counting down the 8 strategies they use to do that, from worst to first. 3 are lies that get sold to normal earners and quietly break the math. 5 actually work, even on a regular salary. And the strategy at number 1 is the one your parents told you was reckless. Let's start at number 8. Number 8. Gold. The classic inflation hedge. The asset every doomer YouTuber will tell you is the only real money. And right now, the case for gold has never looked stronger. Gold just hit $4,460 an ounce. It's at 53 new all-time highs in 2025 alone. JP Morgan thinks it hits $6,300 by the end of this year, so this should be an easy call. Gold goes up when inflation rises. End of story. Except the math doesn't survive a longer look. In January 1980, gold hit $850 an ounce. That was its real inflation-adjusted peak. If you bought at that peak, you didn't break even in real purchasing power until September 2025. 45 years. 2 generations of waiting just to get your purchasing power back. And the long-run return tells the same story. From 1971 to 2024, gold returned 7.9% a year. The S&P 500 returned 10.7%. Across half a century, gold underperformed equities by nearly 3% annualized. That compounds to roughly 4 times less money at the end. Here's what's different about the current gold rally, and it's the part most YouTubers won't tell you. Since 2022, central banks have been net buyers of gold at a pace not seen in over 50 years. China, India, Turkey, Poland, they've been accumulating reserves. That's structural demand from sovereign actors, not retail panic buying. So the current rally has a real economic basis, not just hype. But here's the catch. Central banks aren't buying gold to build wealth. They're buying it to diversify away from dollar exposure. They have a different problem than you do. Their objective is reserve stability across decades. Your objective is to grow your net worth on a 30-year working horizon. Those are not the same trade. Tyler bought gold during the 2022 inflation spike. He's up. He should be celebrating. But the equity index he could have bought instead is up more. Even in gold's best modern moment, with central banks pushing the bid higher every quarter, the math says it doesn't earn a high spot on the ranking. Gold preserves wealth. It doesn't build it. There's a difference, and rich people who already have the wealth understand that distinction. People still building wealth shouldn't confuse the two. That was the easy one. The next 2 are bigger, including the strategy every finance influencer is currently selling you. Number 7. Crypto, framed as digital gold. The pitch goes like this. Fiat is being printed into oblivion. Gold is heavy and slow. Bitcoin has a fixed supply of 21 million coins. Therefore, Bitcoin is the new gold for the digital age. A perfect hedge against inflation. It's a clean story. Beautifully simple. And the math doesn't support it. An inflation hedge is supposed to protect your purchasing power when you need it most. That means when inflation spikes, when markets panic. When your wages are stretched, the hedge holds value or rises. Bitcoin doesn't do that. Bitcoin behaves like a risk asset on steroids. In 2022, when inflation was hitting 9%, Bitcoin fell from $69,000 to $16,000, a 77% drawdown, not a small dip, a loss of more than 3/4 of its value during the exact inflation cycle it was supposed to hedge against. That wasn't a one-off. After the 2017 run, Bitcoin lost over 80%. In 2025, it fell from 126,000 to 80,000 in a matter of months. Schwab data shows Bitcoin's 3-year max drawdown is still 50% or more. Here's the structural problem. Bitcoin's price correlation with the Nasdaq has run elevated since 2020. When tech stocks fall, Bitcoin falls. When risk appetite drops, Bitcoin drops harder. That correlation behavior is the opposite of what an inflation hedge is supposed to do. Gold's correlation with equities during stress periods is near zero or negative. That's what makes gold a hedge. Bitcoin moves with the market, not against it. Run a backtest. Take a standard 60/40 stock and bond portfolio, add a 10% Bitcoin allocation. What happens? The portfolio's returns go up during bull markets, but its drawdowns also go up during bear markets because Bitcoin amplifies whatever the equities are doing. You haven't added a hedge, you've added leverage to the position you already had. Tyler bought Bitcoin in 2021 because the financial press told him it was the new gold. By 2022, his position was down 70%. By the time it recovered, he'd lived through 3 years of stress while his neighbor's boring S&P 500 portfolio quietly outperformed without the heart attacks. Now, Bitcoin as a speculative growth asset has its own argument. Over the last decade, it's beaten most other asset classes. That case can be made. If you want exposure as a speculation, size it as 1. But the digital gold framing, that fails the math. Gold doesn't lose 77% when you need it. An inflation hedge that requires you to also hedge against the hedge isn't an inflation hedge. It's a high volatility risk asset wearing a costume. If you came here for rental property advice, the next 2 minutes are going to hurt. But stay with me, because everything after the rental segment is what actually builds wealth for normal earners. Number 6. Rental real estate empires. This is the big one. The strategy every finance influencer on your feed is currently selling you. Buy your first rental, then your second, then your 10th, then you're a millionaire landlord living off passive income while you sip Mai Tais on a beach. Let's run the math on rental property. Number 1. The median US home price right now is $403,200. You put 20% down, that's $80,640 of your own cash. You finance the rest at the current investor mortgage rate, which runs around 7%. Your principal and interest payment is roughly $2,140 a month. Property taxes nationally average just over 1% of home value. Add insurance. Now you're at around $2,650 a month in fixed costs before anything goes wrong. Median market rent on that property is probably around $2,800 a month. Looks great, right? $150 of monthly profit. Except, honest landlords reserve 8% for vacancy. You're not collecting rent 100% of the time. That's $224 a month gone. Honest landlords reserve 10% for capital expenditures: roof, water heater, HVAC, appliances. Things break. That's another $280 a month. If you don't self-manage, that's another 10%, $280 more, added up. Total real cost, $3,434 a month against $2,800 in rent. Tyler is losing $634 a month on rental property number 1. That's $7,608 a year. He needs the property to appreciate by 2% annually just to break even on cash flow. And we haven't talked about the time cost. The average single property landlord spends 15 to 20 hours a month on calls, contractors, lease renewals, and tenant turnover. At a $45 per hour blended wage, that's another $675 to $900 of opportunity cost every month. The property doesn't just lose money, it steals your weekends to do it. Now here's the part nobody on TikTok will tell you. The reason rich people own rental empires isn't the cash flow, it's the tax structure. There's an IRS designation called real estate professional status. If you qualify, depreciation from your rental properties can offset your ordinary income, including W-2 wages, business income, capital gains. But here's the catch. To qualify for real estate professional status, you have to spend more than 750 hours a year in real estate activities, and more than half of all your working time has to be in real estate. If you have a normal job, you cannot qualify. The math that makes rentals work for the rich is literally inaccessible to you. The depreciation still happens, but you can only use it to offset passive income from the property itself, which we just demonstrated is zero or negative. So why do rich people own rentals? Because at 50 units, the math inverts. One vacancy doesn't kill you. You hire one full-time manager instead of paying 10% per door. You get commercial financing terms a retail investor can't access. The principal owner qualifies for real estate professional status as their full-time job. The depreciation shelters millions in active income. The unit economics that lose $634 at one property generate millions at 50. Rental real estate is a business model that works at scale. It is not a passive income strategy at one or two units. It is not a tax shelter for normal earners. Anybody telling you otherwise is selling you a course. Those are the three rich people let you copy. They sound smart, they break under honest math. Now the five they actually use, counting up to number one, which is the one your parents told you was reckless. Number five, Series 1 savings bonds and tips. Nobody talks about these correctly. Most finance YouTubers skip them entirely because there's no affiliate commission and no course to sell, which is exactly why they deserve a spot on this list. Series I bonds are US Treasury savings bonds. The interest rate has two parts: a fixed rate that's locked for the life of the bond, plus an inflation adjusted rate that resets every 6 months tied directly to CPI. Right now, the composite rate is 4.26%. The fixed portion is 0.9%, meaning every dollar you put in is guaranteed to beat inflation by 0.9% for the next 30 years, no matter what happens to prices. Let me make that concrete. Take a $25,000 emergency fund. In the average American savings account at 0.38%, that earns $95 a year. In an I bond at the current composite rate, the same $25,000 earns $1,065 a year. Same money, same liquidity profile after the lockup period. Roughly 11 times the return. That's not a wealth multiplier. It won't make you rich. What it does is solve the cash problem we opened this video with. Your savings account is paying 0.38% against 3.8% inflation. You're losing 3.42% of your purchasing power every single year. I bonds erase that loss and add a small, real return on top. TIPS work similarly. Treasury inflation protected securities. The principal adjusts to CPI. You get a small fixed coupon on top of that adjustment. Hold them in a tax-advantaged account because the inflation adjustment is taxed as income annually, even though you don't receive it until the bond matures. The limit on I bonds is $10,000 per person per year. There's a 1-year lockup and a 3-month interest penalty if you redeem within 5 years. So they're not a substitute for a checking account. They're a parking spot for cash you don't need to touch in the next 12 months. Use them for your emergency fund, your short-term savings, your house down payment fund. Not your retirement portfolio. The returns are too low to compound a working lifetime of wealth. They're the boring, foundational layer the rich already have, and the layer most regular earners don't. Number 4 is where most people get it half right and half catastrophically wrong. Number 4, your primary residence. But only with leverage, and only sometimes. This one needs honest framing. Buying a house doesn't automatically build wealth. The marketing pitch says it does. The math says it's conditional. Here's the part most homeownership pitches conveniently leave out. When you buy and sell a home, the round-trip transaction cost is about 8%. 6% in real estate commissions, plus closing costs on both ends, plus moving costs. On a median $403,000 to $200 home, that's $32,000 gone the moment you transact. Existing home prices are currently growing at 0.6% a year nationally. That's below inflation. At 0.6% appreciation, it takes more than 13 years just to recover the transaction costs of buying and selling. Anyone who tells you a starter home is a wealth-building tool is ignoring the math on the cost of getting in and out. Here's when it works. You buy below your maximum stretch. You hold for at least 7 years, ideally 10 or more. You take a fixed-rate mortgage. The house performs roughly in line with inflation, which historically it does. Slightly better, here's when it breaks. You stretched to your maximum approval at peak prices. You took an adjustable rate mortgage that resets higher. You sold within 3 years and ate those transaction costs. Or you bought in a market that overshot, like much of 2022, and watched prices stagnate or decline through 2024 and 2025. The leverage cuts both ways. A 5% home price decline on a 20% down payment is a 25% loss on your equity. The same leverage that amplifies gains in the working scenario amplifies losses in the breaking one. The wealth doesn't come from the house appreciating dramatically. The wealth comes from the leverage and the inflation hedge on the debt itself. Most homeowners think they own a growth asset. They actually own an inflation hedge with a mortgage attached, which becomes a critical distinction at number one. Number three, pricing power businesses. This is the Buffett angle. It's the most sophisticated win on the list. When inflation rises, every business faces rising input costs. Wages go up, materials go up, transportation goes up. The question is, can the business pass those costs through to its customers without losing them? If yes, that business wins from inflation. If no, that business gets crushed. Costco raised its membership fee in 2024 from $60 to $65 for base members. Member renewal rate barely moved. It stayed around 93%. That's pricing power. Visa and MasterCard charge a percentage of every transaction. When inflation raises prices, their revenue rises automatically without them lifting a finger. That's pricing power. Pipelines and railroads work the same way. They charge a percentage or a per unit fee on what flows through their infrastructure. Their customers have nowhere else to go. As nominal prices rise, their revenue rises. That's pricing power. Buffett's classic example was See's Candies. The brand let Berkshire raise prices every year for decades without losing customers. That's pricing power. Now look at the opposite. An airline that competes with three other airlines on the same route. A grocery store that sells the same Coca-Cola as the store across the street. A commodity manufacturer making screws that look identical to every other screw on the market. Their input costs rise during inflation, but if any of them raises prices unilaterally, customers switch to the cheaper competitor. So they absorb the cost. Their margins compress, their earnings collapse. That's why during inflationary periods, you see giant gaps in the stock market between companies that look superficially similar. One owns a brand or a network or a piece of infrastructure customers can't bypass. The other competes only on price. Inflation rewards the first kind and destroys the second. Rich investors don't just buy stocks, they buy pricing power. And owning the broad index gets you weighted exposure to dozens of these businesses without having to pick them yourself, which is exactly why number two works. Two more before the closer, and the closer flips everything you've been told about how rich people handle houses. Number two, broad equity ownership through an index fund. Owning the S&P 500 means you own a basket of roughly 500 of the largest American businesses. Most of them have pricing power. Most of them pass inflation through to their customers. As a group, they have done this for 100 years. The numbers. The S&P 500 has returned about 9.5% a year nominally over the last century. After inflation, that's roughly 7% in real purchasing power. Compounded over decades, that's how regular salaries become real wealth. Here's the critical part. Equities have beaten inflation in every rolling 20-year window since 1928. Not most, every. There has been no 20-year period in modern U.S. history where holding the broad equity market lost to inflation. But here's the catch that Finance YouTube never mentions. The average investor doesn't get 7% real returns. Industry research consistently shows that retail investors underperform the funds they invest in by 2 to 4% annually. They buy after rallies. They sell during crashes. They chase last year's winner. They panic and go to cash at the bottom, then pile back in at the top. The index returns 7% real. The average investor in the index gets 3 to 5% real. That gap, the behavior gap, is the single largest destroyer of retirement wealth in America. The strategy doesn't fail. The investor fails the strategy. The fix is automation. Set up automatic contributions to a low-cost total market index fund. Don't look at it during downturns. Don't change your allocation based on the news. Don't try to time entries. The math only works if you let it work for 20 to 40 years without interfering. That's the boring foundation. Max your 401k. Max your IRA. Open a taxable brokerage account. Buy a low-cost total market index fund. Hold for decades. Don't touch it. Why isn't this number one? Because it's the expected answer. Everyone who's watched a single finance video knows index funds beat inflation. The unexpected answer, the one rich people use that normal earners actively avoid, sits at number one. Here it is. The strategy your parents told you was reckless. Number one, long-term fixed-rate mortgage debt, not real estate, the mortgage itself. Tyler, remember Tyler, has been told his entire adult life that debt is bad. Pay down the mortgage, be debt-free. That's what his parents drilled into him. And his parents weren't wrong. They were just operating in a different world. Tyler's parents grew up watching 18% mortgage rates in the early 1980s. At 18%, debt is the enemy. At 6.5% against 3.8% inflation, the math inverts completely. A 30-year fixed-rate mortgage becomes the only consumer financial product on planet Earth that lets a regular salary earner short the US dollar at a fixed nominal rate. Read that line again. And one more thing about that mortgage, the 30-year fixed-rate consumer mortgage barely exists outside the United States. In Canada, the UK, Australia, mortgages reset every few years. In most of Europe, the loan term tops out at 10 or 15 years. American homebuyers have access to a financial instrument that homeowners in most developed countries can only dream about. And most Americans don't use it correctly. Here's the math on using it correctly. Tyler borrows $322,560 at today's 6.5% rate to buy a median home. Inflation runs at, say, 3% a year. 15 years later, his remaining loan balance is around $224,000 in nominal terms. But in today's purchasing power, that $224,000 is worth about $144,000. The debt shrank by $80,000 in real terms while Tyler slept. Now here's the opportunity cost calculation everyone misses. Suppose Tyler has $500 a month of free cash. The conventional advice says, throw it at the mortgage. Pay it down faster. Get to debt free. Let's run both paths over 15 years. Path A, Tyler accelerates the mortgage with $500 extra a month. He pays off years early. He saves roughly $65,000 to $75,000 in interest over the original loan term. That feels good. The mortgage is gone. Path B, Tyler keeps the original mortgage and invests that same $500 a month in a broad index fund at 7% real returns. After 15 years, that account is worth roughly $158,000 in today's purchasing power. $158,000 of liquid wealth versus $65,000 of saved interest. The investing path wins by roughly $90,000 in real terms. And Tyler still owes a mortgage at the end, but that mortgage has been eroded by 15 years of inflation. The debt is smaller in real terms than it looks on paper. This is why rich people don't pay off their mortgages early. They take the longest fixed-rate term they can get. They invest the difference at 7% real returns in equities, and they let inflation eat their debt for 30 years. Your parents called debt the enemy because at 18% it was. At 6.5% against current inflation, it isn't the enemy. It's the wealth strategy. The same loan amount, same monthly payment, same 30 years. But a completely different financial outcome depending on which math you believe. The house is the inflation hedge. The mortgage is the wealth strategy. And that's the difference between owning a house and using a house.